team and partners, welcome to Nirmal webinar. Today we have Mr. Chintan Haria, Head of Products and Strategy, ICICI Prudential Asset Management Company. I think Chintan is with ICICI, I think since 2005, so quite a long time. And he is one of the product person from the AMC side with whom we keep listening on the various topics, whether on the global side or the domestic side. uh, Product interaction front also we keep getting his views, we have Chintan today in our webinar. So Chintan, quickly, on the market side, if we will talk about, so there are a lot many factors which are working, on the different dimension and the different directions probably. Uh, if I'll, put together, and I would like to ask you how, market will shape up from here on, considering all the factors. So how do you see markets from here?
Yeah. So if understand markets over the next 3-4 years, how they will behave, it's important to understand what has happened in the last 15 years and also what is happening right now as we speak. And that will give us a sense of what the direction of the markets could be. So from the Lehman crisis of 2008, we've seen interest rates continuously coming down, and falling interest rates, of course, along with easy liquidity, meant that asset prices across the board had gone up. So there was governments which were borrowing more money across everywhere. If you see any balance sheet of any government, they had borrowed more money. Interest rates were artificially low. In fact, in Europe, they were negative for almost 4-5 years, starting from 2015-16 and till recently. Now they are turning positive. And over the last 5-7 years, especially the last 2 years post the pandemic, all asset prices have gone significantly higher. Now, the reason for that was very low interest rates. Now, with interest rates going up, clearly there is a deceleration or an asset price correction that has to happen. And which is what we were basically betting on in the last 6-8 months, when we were basically telling people to be predominantly in asset allocation schemes like asset allocator fund, which incidentally in January, February, March itself had gone to one of its lowest at about 15-20% investment level. So clearly the valuations were expensive in India and globally, and with interest rates rising, the valuation correction had to happen, and that has happened. So if we see the expensive areas of the world and the market, typically the technology names both in India and abroad have corrected the most. Those companies which did not have cash flow, that have corrected the most. And if you look at the private equity markets, where every day we were hearing of a unicorn born in India, which is a company with more than $1 billion in expected estimated value or the deal happening there, that is all turning around. So we are going to be in a scenario over the next 6 to 8 months where, because of the high inflation numbers, the central banks are going to be more and more hawkish. However, after 6 months, with now, if you see the commodity prices in the last 3 months, all commodity prices have fallen sharply. You name it, cotton, natural gas, oil, aluminium, copper, zinc, all the commodities have fallen sharply, which eventually will lead to the inflation numbers looking a lot more digestible from a central bank perspective, and central banks will stop increasing rates. So I do expect that after October, the US central bank may not need to raise rates further, which itself will be a good sign from a market perspective. Now, there are two possibilities over the next 3 years or next 6 months, I would say. One possibility is that the US goes through a very significant slowdown, which can cause a big recession in the world. I give it a less than 20% probability of that happening, maybe 80% probability of the second scenario happening. The second scenario is that from here till October, the interest rates are increased. There is tightness in the monetary scenario, but when inflation numbers start to look much lower on a YOY basis because commodity prices have fallen, you will find Federal Reserve of US changing its stance and becoming dovish instead of hawkish. And so the equity markets will probably stabilize. A data point which everyone will probably find it interesting. Since October 2021, we've seen foreigners selling in India every month to the tune of 40,000 crores. And in May and June this year, we've seen foreigners selling 54,000 crores and 58,000 crores in May and June. That is last 2 months. Total of 3 lakh crores sold in 7-8 months. Effectively, this is one of the sharpest selling by foreigners. And in this sharpest selling, because all of us, and especially all of you, have done a great job of channelizing Indian money coming into equities, the fall is only 11%. The last time we saw this kind of a selling by FIs was in 2008, where they sold 5% of their overall India holding, and that led to a market fall of 55%. Versus a 55% fall in 2008, FIs have sold currently exactly the same amount in terms of their holding. They've sold 5% of their holding, and we are down only about 11 to 12%, showcasing the strength of the domestic investor. And that's where we believe over the next 3 to 5 years, the domestic investor strength will continue, which will help markets to do well in India, while the rest of the world will be in pain, especially Europe, because if the Russia war does not settle, Europe will not be able to bear the gas price cost for their electricity, and that's going to cause a lot of pain in their economy. So already if you see, euro is at a 20-year low right now. So just to summarize, the world is going to be a very volatile place for the next 6 months. But for us in India, the good news is that FII selling in July has been much lower. It is versus an average selling of 50,000 crore a month. FIs in the month of July are looking like selling of something like 20,000 to 22,000 crores. So we may exit July at 1/3 the selling of FIs that we've seen in the last 7-8 months, which itself is a positive sign that incrementally there is a pause in the FI selling, which should eventually help our markets. But clearly not the time to be overtly bullish, but there are many pockets which are looking interesting. Thank you. You're on mute, Ritu.
Chintan, you have put it, many factors, like you have talked about the inflation and the commodity prices, which we have seen sharply come up. So in the market, there are, two kind of a forum. One says that inflation is good for the markets or the good for the economy. And the other side of the part is, inflation is not good. At the same time, rising oil prices is bad for the Indian economy, basically. But if historically we see the data and all, so probably that shows or that tells some other story. So what's your thought on this?
So clearly, when crude was averaging about $120, $125 for the previous 3 months, it was a big negative for India. And that showed also on our currency reserves coming down from $640 billion in January to almost $585 billion in June. That pressure is now much lesser because crude has corrected to $100. It's still slightly above what our comfort level would be. At $80 crude, we are very comfortable. At $70, we are very comfortable. But at $100, it is a stretch. At 125, it was a severe stretch. So while crude has come down $25, which is a good $25 billion of savings for India, and it is good. If it comes down to 80, it will be even better. Then definitely we will see Indian markets do exceedingly well. But as far as the next 3 to 6 months is concerned, we will be probably determined, or we will be guided more by what's happening in Europe and US and less by what's happening in India or what are the earnings requirement in India. So inflation numbers yesterday came in India, which was significantly high, understandably so. And that basically led to banking shares getting sold off with the expectation that RBI may increase rates, which is understandable. So every fall in the market is bringing us an opportunity in India to buy, because unlike the rest of the world, we are not reliant on international, gas for our energy requirements. We are still a coal-based economy. India is a friend of Russia. India is a friend of US. India is a friend of everyone in general. So that is also geopolitically helping us gain ground on the exports. So things are good with India, but the rest of the world is not so good right now. And we will hear probably a lot of negative news from Europe in the next 3-4 months because their economies are in strain. So net, in India, you can invest. In US and Europe, you should be very skeptical, or you should be scared. I would still not advise thinking of US tech as a destination where you would want to put too much money, because for 10 years, technology shares did well because interest rates were zero and their growth was excellent. Now their growth is not going to be so strong, and the interest rates are going up, so that pain will be there. The pocket of cheap valuations is in Asia. If you look at Hong Kong, South Korea, Taiwan, Philippines, Brazil, Indonesia, even mainland China, there the valuations are much cheaper. If India is at 18 times forward, they are at about 11 times forward on the price to earnings basis. So Asia is something which, if the world stabilizes and there is a rally, Asia can actually do well than India, and followed by US. If the world remains consolidated and volatile, India will do well, followed by probably Asia, followed by US. So clearly, US remains number 3 across all market conditions in our view, while Asia and India can toggle depending on how the market scenario prevails. So India, there is place to make money. We are currently at about 250 lakh crore of market cap. In the next 5 years, we should touch about 400 lakh crore of market cap. And if that happens, there's 150 lakh crore worth of market cap creation that will happen, which can be earned by all of us by being invested in the right place in equities.
Okay. So as you said that India is one of the destination where investors needs to put money and completely, avoid the US, because in any dynamics it's coming in a third place. So if अगर हम लोग इंडिया की बात करते हैं तो इंडिया में which is the pocket where do you see as of now, investors should look at? Like market capitalization wise, there are the different pockets like large cap, multi cap, mid cap. So there are the diversified product or strategies also. So which pocket do you see as of now investors should look at from 3 to 5 years kind of a perspective?
So clearly, flexi cap or multi-cap mandates are preferred in general, because within large cap, mid cap, and small cap, you'll always find stocks which are interesting. Currently, in the last 2 years, we've seen small cap and mid cap do exceedingly well. So they were due for a correction, and a large part of the correction or the froth has definitely been taken away, because in the last 2 months, we've seen small caps collapse significantly. But if we look at from an investor standpoint, across sectors, India is one of those unique countries where there are so many good companies across sectors that you can always create a diversified portfolio out of those different sectors and different stocks. So like IT has corrected or technology has corrected right now by 30 to 40%. There are opportunities opening up. Banking as a sector has done virtually nothing for the last 5 years, and it continues to be beaten down because, as you would all be aware, banking as a sector is one of the most overowned by foreigners. And when foreigners are selling so much, it is the banking sector which is taking a hit. Auto sector is turning around. So our top 2 picks in terms of domestic oriented sectors is banking and auto. And we also like pharma and technology right now after the correction in terms of a stability to the portfolio. A core allocation or a large allocation towards banking and auto. And if you want to basically have a defensive portfolio positioning, then pharma and technology are something which we basically added. We do like the entire export story because the way the world is panning out, exports are going to be important from an India growth story perspective, and that's where all the export-oriented industries and the services-oriented industries we like. So what we dislike, of course, is those stocks which were very expensive to begin with and not justified necessarily by their potential earnings growth capability. If there are, for example, paint stocks which are 100p or jewelry stocks which are 100p, they may or may not be necessarily fit for a very large allocation in your portfolio, because the de-rating potential in this high growth, high valuation sector, we've seen that happening for the last 1 year, and in an increasing interest rate scenario, you will find de-rating to happen in these expensive names. So it's better to be in cheaper names, which probably are the value names, which probably have a business model where cash flow generation is strong. Even if they are not growing too fast, at least they have a steady, sustainable business model and they are valued at less than 20 times. While most of these 80, 90 PE names, they will probably not justify their PEs given the high interest rate environment.
It means the value kind of a theme you are saying that probably is going to work out going forward.
Yeah, so growth at any price, which was working for almost 5 years between 2015 to 2020,
Correct.
may no longer work. a combination of value and a blend approach with growth at reasonable price is going to work better in our opinion, and it will also ensure investors lose less if there is a big correction in the market. So I think if we weigh in the risks and rewards, it is better to be in value or in growth at reasonable price. But if you are in stocks which have growth at any price, in other words, they are very, very expensive, but they are good quality names where growth is ascribed, it does not probably add value to your portfolio. No point in buying a 90p or a 100p stock if the growth is there, but they are so expensive that they are not going to give you any immediate return, especially in a high interest rate environment.
Okay. On the asset allocation perspective, if we will talk about for the clients, so do you see this is the good time for the asset allocation product, or do you see the the equity products which is more feasible or good at this point of time to buy?
So Ritu, effectively all clients will always have some equity in their portfolio. They'll have debt for sure in their portfolio, and arguably in India, debt plus real estate account for more than 80% of most clients' portfolio. Equity is 20 or 30%, that too. For many clients, it's a stretch. So in India, we're generally less on equity. That trend is changing, but we are tilted towards debt and real estate. I do believe that asset allocation in the right manner, if the investor is sitting with the relationship manager or the advisor and gets a right asset allocation plan around, they will find a much larger allocation to equities and then probably followed by debt. And within equities, I think the entire dynamic asset allocation bucket, which is balanced advantage fund kind of a fund, can definitely help investors to achieve their long-term goals without having to worry about market volatility. In fact, market volatility becomes their friend, because a fund like asset allocator fund of fund would buy when the markets are cheap, sell when the markets are expensive. And with a 4-year history, they've basically been able to, prove how they will add value to the client as well. And Balance Advantage Fund, of course, has a more than 10-year history. So for the investors, I would believe asset allocator fund of fund can get the best of all worlds in terms of allocation between equity and debt. And within equity and debt, which are the funds that they should basically invest in. And so asset allocation products should be the core for all individuals, all of the investors. And then you keep adding, the focused category or the dividend yielding category. Like you mentioned, value and, cheaper names can actually do well. So high dividend yielding stocks or the focused category where across market capitalization, you would pick up those stocks which have a good future. That is also a sustainable model of creating an overall portfolio balance. In general, what we prefer for investors is that you should have 50% of your money in asset allocation schemes, which will take care of your equity and debt requirement. Ideally, the money should, whatever you invest, should have a more than 3-year time horizon. So 50% is in dynamic asset allocation or balance advantage fund category. 10% can be in gold or silver, as the case may be. The balance, 40%, you can put it in debt, you can put it in international equity, you can put it in individual sectors or themes which you like, or you can simply put it in a diversified equity fund, which will allow you to participate in the market growth over a period of time. So, but important part is 50% should be in balance advantage fund or the asset allocator fund of fund, which will help basically create a good base around which you can build the rest of your portfolio. Eventually, this will lead to a great long-term wealth creation journey for all of you.
As you said, like 50% should always be now, probably that our investors should look at this, all the time, probably, to manage the portfolio. Some kind of, aggressive investors, basically, if we'll talk about, so they do not believe in this asset allocation strategy. The simple reason is that the thought is like, the some part is in a debt and which is not giving us a return and all. So those kind of clients, how do you suggest, like how they can fit this asset allocation in their portfolio, and how the asset allocation product can help them also?
Yeah, so as far as aggressive client or the definition of aggressive client is concerned, my last almost 7 years of history dealing with investors as head of products. Prior to that, of course, I was in investments, so my interactions with investors used to be limited. But in the last 7 years as head of product, I've interacted with investors across India, across cities, across towns. And the one thing which always comes out is that they may say that they are aggressive, but they are aggressive only when the markets are doing well. When the markets start doing badly, the most aggressive investor also wants to basically save themselves from the downside of the market, or they get jittery or they get worried. And to that extent, uh, you should be in a fund which is aggressive when the markets are cheap, and which is defensive when the markets are expensive. In other words, when the markets are cheap, more money should be in equity, which will make you aggressive. And when markets are expensive, less money should be in equity, which will make you conservative. Currently, the way people react is that when the markets are doing well, they become aggressive. And when the markets are doing badly, they become defensive. It should be the opposite. When the markets are aggressive or doing well, you should try and be defensive in your approach and conservative. When the markets are doing badly, you should go all in and invest when the markets are cheap. So what you do is exactly opposite of what should be done, and hence the asset allocation schemes are the right fit for you, because it is not only today, but in the last 300, 400, 500 years of history of humankind, and we can stretch it back even further, the greed and fear and the herd mentality impact our decision making significantly. And if we want to basically get rid of this decision making through herd mentality, we should be able to be in counter cyclical products like asset allocator fund of fund, which will buy low and sell high. We typically buy high and sell low. You can basically see any of the behavior patterns that you've seen in the last 5 years. In March 2020, when the markets had fallen 30%, most of the people were looking at the exit door or trying to see what they can redeem from where and try to reduce their equity level. While actually you should be putting more money in equities at that point of time. And today, in the last 6-8 months, I would say, when markets were at 18,000 last year, or 18,000 on Nifty, or 60,000 on Sensex, people were looking at what are the buy opportunities that are there in the market, and they wanted to put more money. So this is counterintuitive, but this is how human psychology works. We get comfort when things are going our way, and that makes us put more money in equities. And the reverse happens. When the markets are doing badly, we see losses and we don't put money in equities. To avoid all of this, the simple solution is asset allocator fund of fund. You will not have to worry about all of this. And in fact, your wealth generation will probably be much better off. So whether you are an aggressive investor or conservative does not matter. And when you have the money also does not matter. The beauty is when you put the money, how much money you put, and what kind of an investor you are probably does not matter when you're putting in asset allocator schemes. And if you're truly aggressive and believe you have to be 100% in equity all the time, then you're a different breed of investors. Less than 1% or less than 0.01% of Indians are such who at all points of time have 60, 70, 80% in equity are an aggressive. Rest all are probably conservative investors. So most people should have asset allocator fund of fund. If you're really aggressive, then yes, you will find value in schemes like India Opportunities Fund, Value Discovery, Focused Equity, Dividend Yield. So there are many funds which are there in the market for you to invest if you are an aggressive funder. But if you are conservative, first build your asset allocation bucket and then decide where you want to put in a fully invested fund.
So as of now, whatever we have talked about is mostly on a on our equity front. If we are building a portfolio, so probably we should avoid the global equities at this moment. We should focus on our Indian equities with the categories like flexi cap, and the multi cap is the category, and the asset allocation definitely for the core portfolio. And the sector you said, I think the banking and auto is two sectors you said you are bullish. So banking sector, I just wanted to ask you, banking sector is one of the sector which we see generally is having a high exposure in across products, whether it's a multi cap or the flexi cap or any other large cap kind of a products. So, do you see any kind of added advantage, when investors purchase additionally or investing additionally in this product?
So you are right. Just to answer the previous question on the international allocation, clearly right now, while India is looking good, some allocation to Asia is not a problem in my view. If you look at the valuations in Asia, they're very cheap. So if there is a rally in the markets in the next 2-3 years and Asia participate, Asia can in fact have a 2x beta to India. So Asia can give 2x return to India also if things go right. they are more leveraged, they are more export oriented. So if the world goes through a recession, they can probably not give that kind of return. So risk and rewards are going to be there. 5 to 10% in Asia is not a problem. And if I look at our Global Advantage Fund of Fund also, which is a solution created for international investing, we have about 30% in Japan, about 20% or 30% in Hong Kong, 20% in Japan, another 20% odd in the the Asia dedicated fund of one of our peers. So we are tilted 80% in favor of Asia in our international investing fund of fund, which essentially tells you that we are very bullish on Asia relative to US or Europe. That's one. And second, on the question which you asked on banking, that yes, banking will be about 25-30% of most diversified equity funds. To that extent, clearly there is an exposure which you are anyways getting. But if you look at, say, for example, a pure banking and financial services fund, which has insurance, etc., and banks inside. So we do believe that large cap banking is in a sweet spot, and hence one can look at the bank ETFs or the bank index fund as well. From a pure banking exposure perspective, we also have the private bank ETF. You can look at the pure investment in the banking sector because while you do get exposure to banking through these funds which you have, which are diversified, the sector has underperformed significantly enough that you can take a direct exposure to that sector as well and probably gain over the next 2-3 years. So that's something which we are basically advising clients.
Okay. Chintan, if we'll talk about on the debt side, as you said, max to max, next 6 to 8 months, we might see, RBI can increase the interest rate and all. What kind of a product, as of now, investors can look at? Whether the medium term suits or the investors should wait, park their fund in a liquid fund, and probably after 5-6 months, they should start staggered over the 2-3 months.
Yeah, so if we look at it from even the credits perspective, there is clearly the increase in interest rates in India over the last 3-4 months has made debt mutual funds quite attractive, because obviously with interest rates going up, they've taken a hit, a mark-to-market hit. So last 1 year returns in debt mutual funds have been weak, and that makes it a very good entry point for someone who's looking at a fresh allocation. Within the debt space, it would be wonderful. Essentially, you can think about it that if there is any instrument which gives you more return when the market or the interest rates go up, typically you will have bonds or you'll have papers which will have a fixed interest rates. And if the market interest rates go up and the interest rates of the bond remain fixed, there is a chance that the bond loses in value. But there are floating interest funds in the market which invest in instruments which basically see an increase, which have a floating interest rate or have a variable interest rate. So as interest rates have gone up by 2%, the interest rate on those papers have also gone up by 1.5-2%. More attractive because now you are getting more returns on those papers, and hence the space which we like the most is the floating interest fund. And for most investors, I think the medium-term bond funds or the credit risk funds can also do well over the next 3 years, and they can allocate there. And much like how we have Balance Advantage Fund, the All Seasons Bond Fund is something which we always recommend, because there you'll get a good mix of floating rate papers, government bonds, government securities, and corporate bonds. I think AA and above. So I think it's a good portfolio for anyone who's looking at more than 3-year investment. As far as parking is concerned, I think the usual suspects, arbitrage fund can be a good way to park your money, because it has equity taxation where capital loss risk is very limited. And we are seeing ultra short-term funds also, the yields going up to reasonable levels. So investors can look there as well from a parking perspective. But if you have, let's say, a 1 to 3 year horizon, then the floating interest funds can probably give you a better return than arbitrage fund or ultra short-term. So less than 6 months to 1 year horizon, ultra short-term arbitrage, 1 to 3 year floating interest funds. About 3 years, of course, also no problem if you have floating interest funds. And not the time right now probably to go into gilt, but in the next 3, 4, 5 months, when interest rates will probably peak out along with inflation, and if a 10-year goes to 8.25, may not be a bad time to invest even in gilt funds, or eventually benefiting out of the fall in the yields when the markets fall, when the inflation comes down or there is a slowdown in the economy. So that's what our view on debt is. Floating interest funds followed by asset, all seasons bond fund kind of fund, and gilt maybe 3-4 months down the line, not now. And all seasons bond fund anyways gives you some exposure to gilts as well. Thank you.
So on the gilts, as you said that GSEC might touch 88 and 8.25 kind of a levels. So do you see like that kind of a level is good for the investors to put money in a GSEC?
Historically, if I see that 8.25 or 8 is a good number, we can, if things go really bad, then we can touch 9 as well. But that would be too lucrative, and it's very difficult to predict whether that will come. But yeah, if we do get 8.25, it's actually a good, because these inflation fears are not permanent. Inflation is not going to be permanent. Yes, if this war continues for 1 year, 2 year, 3 year, and it escalates and there are more countries that get into the war and everything becomes expensive, then we cannot predict that. But that's a less than 1-2% probability. So everything considered rational, inflation is not going to be a problem for long, and hence 8.25 would be a good time to invest in gilts in early.
Okay. So now the third asset class which comes is the gold. So just wanted to ask your view on gold as well.
So gold has been a bit of a disappointment. We've been positive on gold for last, I think, 2.5 years, more so right now. But it's kind of, we were of the belief that when these cryptocurrencies, etc., see a downturn, there is a chance that gold should see an uptick. But and inflationary times, gold should see an uptick. But inflation has happened, cryptocurrencies have come down, but gold has also come down in line with other asset classes coming down. So while going up, it did not go up, but while coming down, it has participated in the downturn. And despite a 5% increase in import duty on gold or customs duty on gold, the prices of gold are still probably hovering around 50,000 or around that. So clearly, it's an asset class which has potential in the next 5-10 years, because it's underperformed in the last 1 year or so. In the last 10 years, if I look at gold in international currency prices, from $1950 in 2011, it is at $750 today, $1750 today. So almost 11 years, gold has given a negative 10% return in dollar terms, which, given the amount of money that is printed, I'll just like to give all the investors a comparative number. The global market capitalization is $100 trillion. It used to be $50 trillion 10 years back. So in 10 years, $50 trillion market cap has gone to $100 trillion. Why has that happened? Because the global debt has gone up from $120 trillion to almost $300 trillion in the last 10-12 years. So we have global debt, which is $300 trillion, because we've all printed money, we've all borrowed significantly. So global debt is $300 trillion. Global equity is $100 trillion. And the available gold, and gold as a reserve currency or a store of value for 5,000 years has stood the test of time. Gold available in the world is only $11 trillion. So debt has increased by $150 trillion in the last 12 to 13 years. Gold has, equity markets or equity valuations have gone from $50 to $100 trillion, while gold is still sitting at only about $11 trillion of total available gold in the world. And this includes the jewelry which is there in your house, my house, all of it. So if I remove all of that, then probably $4-5 trillion of gold is available in the world. So any shift from debt or equity into gold, and possibly we can see gold prices significantly higher. So as a diversification, as a safe haven, and maybe 10% of your overall portfolio, if you have in gold today, it may not be such a bad idea. It will protect your downside. And there may be a chance that if there is a big correction in the equity markets, you can shift that 10% from gold into equity markets at that point of time. But currently, we do recommend having about 10% in gold. And if you do find equities when they are attractive, you can move out to equities at that point of time.
Okay. On the various asset classes, you have given a view and told us like what kind of exposure, retail clients or the clients can have at this point in time in the various pockets of the products. Combined together, if we talk about the retail investors, so do you see that the fund of fund and the asset allocation strategy combined together can help or can fulfill, and they need not to go on the other kind of categories?
Yeah, I think if you have asset allocator fund of fund as your core investment, then you are anyways getting equity, and within that, most of the equity funds which should be a part of your portfolio will be there in asset allocator fund of fund in the right proportion. So if you basically trust it to be your large asset allocation or your asset allocation, and it is a large part of your portfolio, it will have the right amount of equity at the right time based on valuation. It will have within that the funds, because it is a fund of fund. It picks up funds which we believe are good at that point of time. It can pick up large cap, it can pick up mid cap, it can pick up value, it can pick up special situations. So it can have the right mix of underlying funds based on the right equity level at the right time. And at the same time, the debt also. There could be a time where we are sitting on liquid. There could be a time where currently floating interest funds are a very large allocation. So without you having to do anything, you are getting the best of equity, best of debt, and best of gold in a single fund. And that's basically what makes asset allocator fund of fund unique. And I think all investors can have their money there. If you don't have the time to basically pick and choose your stocks, pick and choose your investments, your underlying funds, then allow the fund manager who are professionally doing it and they know what the market direction can be. And more importantly, it's an objective model-based approach towards allocating between equity and debt. So in one fund, you're getting probably the best of everything. You may not need anything else as apart from asset allocator fund of fund. Life would be simple, and I think there is money to be made around that. So yes, instead of you doing it individually where there can be taxation implication also, because the moment you move from one fund to another and you're booking profits, 15% or 10% out of it, if it's an equity fund, will be taken away as tax. While in the asset allocator fund of fund, you basically keep your money for long. Whatever changes happen within it, because it's a mutual fund, there is no taxation. It is very, very efficient in terms of how investors should look at it. And investors should invest with a very long-term view in the ICICI Prudential Asset Allocator Fund of Fund.
So very rightly you said, like the taxation is one of the critical part, which generally when we do the asset allocation, though I am sure the exit load we can take care of, because there is a one year exit load mostly, I mean maximum funds carries. But taxation is which we cannot really ignore while doing the asset allocation. So asset allocator fund for the retail clients perspective is one of the product which they can look at, to do the asset allocation. So combining all things together, if I have at this point in time, very simple question, if I have at this point in time 10 lakh rupees, to invest into, what do you, think? Definitely, asset allocator is one of the fund which we can go and buy at any point in time. But if I would like to put it right now, do you believe like other special situation kind of a products, or the combination of large cap mid cap can help? So how do you bifurcate?
Yeah, so if I had 10 lakh rupees to invest, and let's assume that 10 lakh rupees is the overall allocation that I have, then I would put 5 lakh rupees in asset allocator fund of fund. That would take care of my equity, debt, and gold requirements at different point of time. If I want to be probably aggressive in the markets, I would go for focused equity fund or special situations fund. There I can put another booster STP mode or staggered manner, because I don't expect markets to immediately give any significant uptick. But yes, after 2 years, markets may be much higher than where they are today. So over the next 6 months, if you stagger and invest in special situations, focused equity, dividend yield, whichever product you like, it will definitely help, because these are fully invested equity funds which can help you participate in an uptick in a significant manner. So you choose value, special situation, dividend yield, export services, whatever product you think is fitting your overall profile, you can put 30%, and 20% you can put in international, because in asset allocator fund of fund, you're not getting international. In the other names which I took, special situations, blue chip, focused equity, dividend yield, there you are basically getting India domestic equities. So the balance 20% can be in international, can be in ETFs as well, can be in passive instruments, can be in alternates. There may be some PMSs which you like. So that 20% you can put in there. Of course, in 10 lakh rupees, you will not get a PMS. PMS minimum allocation is 50 lakhs. But just to put it in perspective for investors, typically 50% asset allocation scheme, the balance 50% you can invest in fully invested schemes depending on your risk appetite. And only thing that you should remember is you should have a 3-year view. If you have a less than 3-year view, don't put money in equities, because that can hurt you significantly. Thank you.
Thank you, Chintan. Thank you. And lastly, because we are seeing so many ups and downs in the market, so any kind of points you would like to put across for the viewers?
Yeah, so ups and downs in the market, I think I was just looking at a statistic that in the last 13 or 14 years in the Indian market, every year markets have corrected in the range of 20% to as low as 50% correction, which happened in 2008. So every year, 15-20% correction does happen. Uh, Sometimes it goes up very sharply, then comes down, so we don't realize. Sometimes it goes down and again goes down, so we realize. Like 2008, we would have felt the pain. 2013, we would have felt the pain. 2020, we would have felt the pain. But more often than not, if you ignore these falls and if you see the way the market is, and having seen the markets for the last 17 years, my experience is only 17 years, because in market 17 years is like infancy. I think 30 years experience is teenage in the market parlance, and someone who spent 50 years, then probably you can become a Warren Buffett. So at 17 years, what I've learned in markets is that expect the unexpected, but one thing can be sure, that if you're expecting the Indian GDP to grow, it essentially means that the sales and profitability of the Indian corporates is going to grow, which essentially means that the market caps of the Indian companies are going to grow. And like I had said, when I joined in 2005, India total market cap was 20 lakh crores. I again repeat, when I joined in 2005, total market cap in India was 20-25 lakh crores, roughly, or maybe 30 lakh crores. Then it went up to 80 lakh crores in 2008-9 maybe. And today we are at 250 lakh crores. So in 17 years, it has moved from 35 lakh crore to 250 lakh crore. Our GDP was 20 lakh crore, then it has moved to 300 lakh crore. Our GDP is going to move to 500 lakh crore in the next 5 years. Nothing is going to stop it. I don't think a global recession can also stop our GDP from growing, because in the last 17 years, in fact, last 20 years, 2002 to 2022, except for the pandemic year, which understandably saw our GDP kind of flatten out, every year, without fail, our GDP has grown in nominal terms. So 20 years, we saw a lot of pains, a lot of local pains, international pains, Lehman crisis, international crisis. Our GDP has not stopped growing, which is natural because our population is growing, GDP is growing, output is growing. And so over the next 5 years, if we move from 300 lakh crore to 500 lakh crore, our market capitalization will also move in that direction. How much more or how much around 500 lakh crore, that we can debate. But there is money to be made, and we have to be invested in equity markets if you want to beat inflation in the long run. So with that, I'd probably also, for those of you who are interested, there is a beautiful book by Mr. Gautam Baid that you must read. It's called The Joys of Compounding by Mr. Gautam Baid. It came in 2020. Brilliant book which encompasses wisdom of almost 30 other books that I have read. So I think I'm still in the process of completing the book. I think it's a 370-page book. I've read 300 pages, but it's just fantastic. So all of you, you don't need to read 100 books on finance. Just read this one book, Gautam Baid, Joys of Compounding. I think it will open up your eyes towards the investment world in a beautiful manner, and you will make the right decisions. Thank you.
Thank you, Chintan. Thank you for suggesting us, giving us a strategy in the markets, as well as, suggesting a book. Also, definitely, I will read. So I'm a very bad reader, but definitely I'll try to read this book.
I was a bad reader till 3 years back as well, but I realized that reading books is the, let's say, the agent to the world. And so I started 3 years back.
No, one point you have mentioned that this is a combination of 20 books. You need not to read 20 books. So definitely I'll go for it.
Yes.
And thank you for putting across your views on the different asset classes, and explain which strategy is going to be work going forward. And thank you for joining in, partners. Thank you so much.
Yeah, the author's name is Gautam Baid, Gautam Baid. He's an Indian based in US, and the book's name is The Joys of Compounding. Thank you.
Thank you, Chintan. Thank you so much, participants. Bye.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.